Hi, my name is Ashley Landry, and this is my presentation for Finance695, where we analyzed the 22 companies and picked our top company that we would consider investing in, possibly working for, and who we thought was the most financially stable. When I evaluated each of the 22 companies, I looked at a number of different things, including the liquidity ratios, profitability ratios to make sure that they were increasing, market value ratios, the DuPont analysis to see what was driving ROE figures, stock prices, economic value added, beta figures, and any additional information out there about the companies that may be occurring in the news. I found of the 22 companies that I really thought 3M and Pool Corporation were two top companies that I would consider investing in, possibly working for, and who I thought were the most financially stable. 3M is a company that produces a variety of products, including laminates, passive fire protections, dental products, electronic materials, and a number of different items. They were founded in 1902. Their stock price in 2012 ended at $92.85, and their projected stock price for 2013 was $112.97. I did find one red flag with 3M, which included their profitability ratios. Their profitability ratios, including profit margin, ROA, and ROE, had all been on a decline since 2007. They were on a slight decline, so it's not too much to worry about, but we do want profitability ratios to be increasing and to be high. Compared to X-Ray, their competitor, it was still within normal industry range. After analyzing the DuPont analysis, I noticed that the main thing driving it was actually their leverage figures, which actually were decreasing, but the other figures in the DuPont analysis were all staying the same. So we knew that's what was driving their ROE figures and why it hadn't been increasing. For the positives of 3M, I found that the liquidity ratios were really good figures to cover short-term debt, especially since they had been increasing these figures since 2007, which I think they needed to do. I found after analyzing these that in 2012, they really could cover short-term debt obligations really well. I also found that they had low beta compared to other companies that were out there, showing that they weren't as risky as other companies. I've included a chart that shows their liquidity ratios from 2007 to 2012. Basically, it shows that 2008 had some of their lowest figures for all three of the ratios. Their current ratio was at its lowest in 2008 with 1.64, and in 2012 it ended in 2.20. The same thing for its quick ratios. In 2008 it was at 0.93, and in 2012 it had increased to 1.39. They also continued to keep more cash on hand, with 2008 being their lowest ratio at 0.38 and ending in 2012 at 0.73. With this increase in figures, it showed that when they increased their quick ratio and when we excluded inventory, it showed they were able to cover current assets over their current liabilities, where previous to 2008, they actually weren't able to do that. So I think it was a good thing that they were able to increase their liquidity ratios. The second company that I really thought was impressive was Pool Corporation, and they are actually a distributor of swimming pools and other backyard-related products. They were founded in 1993, and their stock price for 2012 ended at $42.32. I did notice one red flag about Pool Corporation, which showed that majority of their current assets were tied up in inventory, which we didn't have another pool company to analyze, because I didn't know if this might be something of that industry that they keep a lot of their inventory on hand, so that's mostly what their current assets are tied up in. But it seemed rather high, and if the company got into short-term issues, they may have issues covering their short-term obligations. However, being that was the only thing that kind of raised a red flag for me, Pool Corporation had a number of good things that impressed me. And one of the main things that impressed me was their profitability ratios. The company did have decreases in 2009 of all three ratios. However, since then they have been on an increase, and they have actually surpassed 2007 figures with 2012 figures for all three of them. Their market value ratios had been increasing and they were fairly high, especially with the PE ratio, and their market to book ratio was actually one of the highest of the companies that I analyzed. The DuPont analysis showed that the asset turnover had been increasing and that their leverage had been decreasing, which are both things we want driving DuPont analysis, as this shows the companies in good financial standing. They also had low beta figures compared to some of the other companies. This is a chart showing the profitability ratios in the DuPont analysis for Pool Corporation. It breaks down, with the DuPont analysis, it breaks down what's actually driving ROE figures. And as you can see, the asset turnover has been increasing, where it was at its lowest in 2009 at 1.96, and it has increased to 2.52 in 2012. And the leverage ratio has actually been decreasing, with 2008 being its highest figure at 3.65, and it has decreased to 2.76. Just to kind of have some other companies to compare Pool Corporation and 3M to, I kind of researched 3 other companies that I felt were probably not good investments, just to get a good idea of what to compare 3M and Pool Corporation to. And one of those companies was Globalstar, and it's a company that produces worldwide satellite voice and data products. It had a number of red flags, including negative profitability ratios. Its DuPont analysis showed that the interest burden had large fluctuations and that the operating margin was negative. It also showed that most likely net income was causing the negative profitability ratios. The market value ratios were, they had no PE ratios reported in Bloomberg, and their market to book ratio was less than 1, showing that shareholders weren't willing to pay more than their book value for this company. They had extremely high betas, actually some of the highest that were actually reported, and their economic value added was calculated at negative 11.64%. Another company I looked at was Lamar Advertising, and they focus on billboards, logo signs, and other advertising. They were founded in 1902, and I found that just to have another company to analyze, just to have some comparisons, Lamar had negative profitability ratios in both 2009 and 2010, and their DuPont analysis again showed interest burden changes, which were actually the reason causing the negative amounts. And their asset turnover was consistent and rather low, and their leverage ratio was very high. We didn't have another advertising company to look after to see if this was normal of the industry, but just compared to the other companies that I analyzed, this one seemed very high. Their economic value was calculated at negative 4.92%. And the 5th company that I analyzed was Amedisys, and it's a home health services and hospice care. It was founded in 1982 and is the 4th largest hospice care provider in the United States. Again, this one showed profitability ratios that were negative in both 2011 and 2012, and their DuPont analysis showed that the interest burden had large fluctuations and also had negative amounts, as well as they had a decreasing operating margin, which seemed to be driving their ROE figures. Their market value ratios, they had low market to book ratios, which were decreasing and less than 1. And their PE ratio had been on a decrease since 2007. However, in 2012, it did increase to a large amount, and it was projected to increase again in 2013. So just to kind of compare the 5 companies that I analyzed, this chart shows the different ROE figures for the 5 companies, showing that both 3M and Pool had some of the largest ROE figures. Pool with the highest one in 2012 at 29.2%, and 3M had 26.94% as its highest ROE figure. As you can see, Amedisys had some of the lowest figures in 2011 at negative 17.21%, and Lamar Advertising kind of stayed in between 1% and right under 5% on a negative amount. So as you can see, these are other companies that are around Louisiana that are in this boat, and they seem to be not doing as well as both 3M and Pool Corporation. The next company, the next slide that I have is the PE ratios from both 2007 through 2013. And as you can see, I wasn't actually able to compare Lamar Advertising and Globalstar because they actually had they didn't have any figures reported in Bloomberg for these ratios. As you can see, Ametis was on a large decline all the way to 2011, and then it has spiked in 2012, and it's projected to increase to above $25 in 2013. For both Pool and 3M, they kind of took the more consistent route. Pool had actually higher PE ratios, and it's still projected to be increasing from 2012 to 2013. As well as 3M, it's been pretty consistent, and it's expected to increase from 2012 to 2013. I also compared 3M to X-Ray, its other competitor that was out there, and it seemed to be within industry standards, actually a little higher. 3M, their PE ratios were a little higher than industry standards. The next chart that I have is the market to book ratios for all 5 of the companies from 2008 to 2012. And as you can see, we actually had 2 companies that were below $1, showing that shareholders weren't willing to pay more than their book value for these stocks. As you can see, both 3M and Pool have increasing figures going up, with Pool having the most increase from 2010 to 2011, and then a huge increase from 2011 to 2012, where it's just above $7. Lamar Advertising had started out in 2008 and 2009 with a large increase, but it seems by 2011 they were on a large decrease as well. So that kind of presented a red flag for the company. This chart shows the economic value added of the 5 companies, and as you can see, both Pool and 3M had positive economic value added. 3M had the highest positive economic value added at 8.87%, and Pool followed afterwards with 6.18%. Ametis had the lowest value with negative 30.30%, followed by Global Star, which had negative 11.64%. So as you can see, both Pool and 3M have positive economic value added if you were to consider investing in this company. This chart shows the raw betas for each of the companies, and I looked at both the weekly raw betas and the monthly raw betas, and as you can see, both Pool and 3M were very close to 1, whereas Ametis was at 2.129 for its weekly. And also Global Star was at 2.783 for its weekly beta, both showing how extremely high, with those being over 1, they were extremely high, showing how volatile they were. I did calculate to see if I had taken out relative volatility, and 3M actually had figures calculated at 1.11% for the weekly and 1.007 for the monthly, showing that their beta and their correlation coefficient were actually equal, which is a good thing to have if you're considering investing in these companies. So in conclusion, I'm hoping that you'll see that both Pool Corporation and 3M are good companies to invest in, possibly work for, or just if you're looking for companies that are in good financial status. I think both Pool and 3M are companies that you need to consider to adding to your portfolio to see if they can maybe fit your portfolio. And that's it. Thank you. Just in case you couldn't see my presentation while I was speaking.